The cloud is a lie. Everyone in the digital world operates under a shared delusion. You are told that if you run a digital business or you trade algorithms or manage a SaaS platform, your asset exists in the cloud. You are told the cloud is weightless, it's borderless, untouchable by physical geography. That delusion is currently costing high net worth operators millions of dollars in back taxes. Because the cloud is not a magical space hovering above the law. The cloud is a concrete building surrounded by barbed wires. And what most sovereign individuals do not realize until they get hit with a catastrophic audit is this: data has gravity. And where your data physically sits dictates exactly which government gets to tax your wealth. Welcome to the Sovereign Architect Protocol. Today, we are talking about a forensic look into the concept of data residency as debt. I'm going to show you why your default server choice is quietly creating a massive, invincible tax liability. In about 10 minutes, I'm going to walk you through the exact server configuration that triggered a devastating 7-figure audit for a crypto founder who thought he was safe because he lived in a zero tax haven. But to understand how he got caught, you first have to understand the trap that tax authorities have spent the last decade building. Governments are broke. The legacy financial system is drowning in sovereign debt, and traditional taxation is failing. In the analog days, if a government wanted to tax you, they look for a factory, they look for a retail store, they look for a physical office building. This was called a permanent establishment. If you didn't have a physical footprint in their country, they couldn't touch your money. So the modern wealth generator adapted. You packed up your laptop, you formed an LLC in Nevis or the BVI, you got residency in Dubai or Panama, and you declared yourself a sovereign digital citizen. You have zero physical footprint. Therefore, you pay zero tax. But while you were busy optimizing your physical passports, the global tax authorities changed the rules of the game. They realized they couldn't catch your physical body, so they decided to capture your digital shadow. Enter the concept of the digital nexus. A digital nexus is a legal framework adopted by over 130 countries under the OECD's base erosion and profit shifting. The premise is brilliantly terrifying. The new law states that you no longer need a physical office to be taxed in a country. If your business uses a server located within a specific jurisdiction to process transactions, store user profiles, or execute smart contracts, or even run algorithmic logic, that server is now legally classified as your permanent establishment. Let us sink in. You might be sitting on a beach in Dubai with a legal 0% corporate tax rate. Your company might be registered in the Cayman Islands. But if your core PostgresSQL database and your application logic are still on an Amazon Web Service server rack in California, the Internal Revenue Service of the United States legally argues that you are conducting physical business on American soil. You just handed jurisdiction to a country you don't even live in, simply because you clicked the US East from a drop-down menu when you were setting up your hosting. So why does this happen? It happens because developers and founders prioritize speed and confidence over sovereignty. When you hire a tech team to build your infrastructure, they look for low latency. They look for cheap bandwidth. They say, let's host in London. The ping is great. Your IT department isn't thinking about international tax treaties. Your legacy accountant definitely isn't thinking about packet routing. Your CPA looks at fiat ledgers. They don't look at server architecture. This creates a massive blind spot. You are effectively renting server space from Amazon or Google and paying for the privilege by giving up your sovereign immunity. You are incurring server rent, but the rent isn't the $500 you pay a month to AWS. The rent is the 21% hidden equity stake you just gave to the US government, or the 25% you just gave to the UK. Now, you might be thinking, my server just holds code. It doesn't hold my bank account. How can they tax the data? This is where the trap gets sophisticated. The mechanism they use to extract your wealth is called the Value Creation Doctrine. Under the new OECD guidelines, governments argue that raw data, which is a list of email addresses, a raw price feed, a user click, is essentially worthless. Data only becomes valuable when it is stored, when it is processed, analyzed, and turned into actionable logic. Therefore, the financial value of your business is not created where you, which is the founder, are sleeping. The value is created where the CPU cycles happen. The value is created where the processor physically crunches the numbers. Let's look at the example I promised you. Consider a high net worth algorithmic trader. He moves to Dubai for zero tax lifestyle. He built a high-frequency trading bot that scans global crypto markets and executes arbitrage trades automatically. It generates up to $50,000 a day in profit. But he wants the absolute lowest latency to the European exchanges. He hosts the core algorithm on a dedicated bare metal server in Frankfurt, Germany. He thinks his money is tax-free because it flows into Dubai corporate account. But during a routine data audit, the German tax authorities identifies the server. They don't care where the trader lives. They apply the Value Creation Doctrine. They determine that the algorithm, the actual engine generating the $50,000 a day, is physically executing on German soil. The intelligence, the processing, the value creation is German. They classify the server as a permanent establishment. They hit him with a multi-year back tax bill at Germany's corporate rate, plus penalties for undeclared operations. His zero tax strategy was completely destroyed, not by a bad accountant, but by a negligent server deployment. At this point, the amateur asks, how would the government ever know what my server is doing? It's encrypted. This is the most dangerous misconception in the market. They don't need to read your encrypted database to know you are there. They use metadata and discovery protocols. When you operate in a legacy cloud environment like AWS, Azure, or Google Cloud, you are operating inside a highly regulated mirrored system. These tech giants are legally obligated to comply with localized tax authorities. When an international tax agency initiates a sweep, they don't knock on your door. They send automated subpoenas to the data centers. They look for high compute nodes, massive bandwidth consumption, and consistent API calls originating from their jurisdiction. If you are using legacy payment gateways like Stripe, PayPal, or even traditional merchant acquirers, they log the IP address of your application servers. If Stripe is sending your payouts to the Bahamas, but the API calls requesting those payouts are constantly originating from an IP address in London, the system flags the anomaly. Your data footprint is screaming your location to anyone with the authority to ask for the logs. Every gigabyte of data you process in a high-tax jurisdiction is compounding your digital debt. You are leaving a trail of breadcrumbs that leads directly from your offshore bank account straight to a highly regulated data center. This is why traditional offshore planning is dead. It's no longer enough to incorporate your entity in a tax haven. You must incorporate your infrastructure in a data haven. So how do the 0.1% solve this? How do sovereign operators shield themselves from the value creation trap? They execute a protocol known as jurisdictional arbitrage for data. You stop treating IT infrastructure as an afterthought, and you start treating it as a Lego armor. You do not put your central brain in a Five Eyes country. You do not default to Amazon Web Services because it's easy. Step 1. You migrate your core databases to strict data havens. You utilize infrastructure in places like Iceland, Switzerland, or even Isles of the Man. These are jurisdictions where data privacy is enshrined in the Constitution, where non-cooperation with foreign tax authorities is the standard, and where digital nexus laws are heavily restricted. Step 2. You implement data sharding. You never ever keep the complete profile of your business or your capital flow on a single server. You split the database. You put the user identities on a node in Panama. You put the financial ledgers on a node in Switzerland. You put the application logic on a decentralized bulletproof host. If a tax authority somehow manages to superior one of these nodes, all they find is fragmented, encrypted, useless code. Because the data is separated, no single server performs the value creation. Therefore, no jurisdiction can claim a tax liability. If you are generating high-ticket revenue and you do not know the exact physical GPS coordinates of where your data is being processed, you are exposed. You have a massive leak in your hull, and it's only a matter of time before the automated discovery protocols find it. You cannot fix this with a better accountant. You need a technical diagnostics. I run a specialized forensic evaluation of high net worth data residency. During the Sovereign Audit, we map your exact digital footprint. We analyze your cloud provider contracts. We trace the API origin point and calculate your digital Nexus exposure across global jurisdictions. Once we find the leaks, we architect a migration plan to restructure your back end so your data lives strictly in sovereign zero-knowledge jurisdictions. The application link is in the description. Because of the forensic nature of this work, I strictly limit this to 2 clients per month. Map your infrastructure before a government maps it for you.